Thank you so much.
You're an
Sanjeev.
amazing human being and an amazing stock picker.
Always a total
Because I think,
pleasure and delight.
our concept. Hi guys, welcome to the 23rd edition of FINtastic Talks. It's great to be here. It's great to have all of you. And this is a mission which we started last year. And in over 1 year, we have had more than 1 million views. And I would wanted to thank you to everyone for making this happen. And we are now in the new year, and for everyone, new year is about resolutions. Okay, so I wanted to share a little bit of a learning. There's an amazing book I read, which is called Atomic Habits. This is by James Clear. It's about building a habit. And he says that, habits, in order to build them, you have to divide them into 4 steps. One is cue, then other is craving, then response and reward. So these are the things that help you build a habit. So, I wanted to summarize FINtastic Talks. FINtastic Talk is about building a habit of saving and investing to build a second income. So, the whole purpose of and my mission is the second income. My team calls me the second income guy of India. So the whole purpose is that, you have to look at your investments as a separate person or a business. And one day that investment or a business has to give you income equivalent to what you are earning. And you need to have a very strong second income, so that tomorrow there is a pandemic or any other challenge in your life, your second income should be there to support you. And eventually your second income becomes your base for retirement. And retirement is one area where Bajaj Capital does a lot of work. We have probably one of the most amazing retirement planning tools available out there. I hope you have tested it out. It helps you manage each and every aspects of your retirement, each and every government scheme, each and every benefit, how long will your money last, how you need to manage it. So point is that, but it is very, very important to build a second income. And I wanted to summarize, what we have talked about in the last 22 episodes. So number 1 is behavior. So it is very important that your behavior towards money will determine whether you are able to build a second income or not. At the end of the day, just to summarize here, that investing is a process, and investing will take time, and investing needs to be done. So at the end of the day, if you don't take out that pain of putting some money away for future or building up that investment, it's not going to happen. So your behavior, attitude, your money is the first foundation step. Second thing is discovering risk versus inventing risk. Investing is all about risk management. It's all about taking calculated risk. It's all about taking a decision what to do, what not to do. And your risk will determine the kind of return that you will get. Inventing risk is when we overthink. We keep thinking and we procrastinate and we don't take action. So guys, don't invent risk, discover risk, and so that you can manage the risk. And whatever is easily available or seen is actually not a risk. Risk is something that nobody is out there is going to be able to predict, or very few people would have predicted. So don't overthink about risk. Understand the risk and learn to manage it. And finally, time. Look, investing is not a short-term game. Okay? So in the short term, you may make money or you may even lose money depending on how the market is. Because it's like a tide. When the tide is there, even the good ships and everything good will go up. When the tide goes down, even the best will go down. So for some time, but they may not go down as much as others. So point is, it's all about time. And building wealth is all about patience, persistence, making mistakes, but not repeating your mistakes. Okay, and for those who are really new in the journey, I would recommend you that, look, guys, before you get into this journey, must learn. Because today people are doing crypto, people are doing XYZ, they're into trading, but they don't understand the basic concept of wealth creation. And it is important that when you enter something, you must understand that concept of wealth creation. and it is very, very important. And for that, we have a program called Be FINtastic. Please look it up. It's 15,000 rupees. If you don't like it, it's 100% refund. But it's a 3-week program which gives you the whole basics of investing, wealth creation, how to create long-term wealth. And if you don't like it, there's no money to be paid. But at the end of the day, the whole concept is that if I understand it, then nobody can misguide me. And this is a race that I'm going to win eventually, because this is not a race which is won by the people who's running the fastest, but it is a race, a person who has the stamina and who keeps running it. Because if the behavior finance said that if you have stayed in the market for 10 years, then there is not even a 1% chance that you won't have got a good return. But it is us who come in and go before that 10 years, when the market is good, everybody is talking about investing. Like right now, people have made a lot of money and they come in now, and then when the market is correcting, they go out, they get scared. They are the people who lose money, because right now you're already slightly late if you're looking at a short term. But if you're looking at a long term, then there is never a right time or never a wrong time. All times are good time to start investing. But further, you know we have an amazing person with us today, Chandresh Nigam. He's the CEO of Axis Mutual Fund, and Axis has been one of the best performing mutual funds with very innovative schemes. And he personally is known as one of the most innovative and consistent and the persistent persons in the industry. So without further ado, I will like to invite Chandresh to join us today.
Hi,
Chandresh,
Sanjiv. Thanks.
yeah,
Thanks for having me. Really wonderful to be here with
no, no,
you and
it's
all your viewers.
No, it's thank you. It's great to have you. And I always admire that you are considered the rock of the industry. The most consistent, the most dedicated person. And that is something we want to understand. And obviously, Axis has been a tremendous performance. Yes, there are times when market has been moving in a very different manner. Sometimes growth stocks are doing well, sometimes values, sometimes small caps. But at the end of the day, I think Axis has been one of the most consistent performers. So, Chandresh, for our viewers today, we have a slightly different way of starting. We want to understand the person also. Otherwise, we attend so many talks where people are talking about themselves, or this is happening, this is in the economy, this is what is happening, this is a fund that is there. But we want to understand Chandresh as a person. So just tell us a little bit about your childhood,
Okay.
about your parents and your growing up, and what did you learn from your dad or mom, something that you want to share with everyone here.
Okay. First, thanks for all the nice things you've said. So it feels nice to, in some sense, be recognized for some of the things which I and my team have been doing in the industry. I think we started this business pretty late as compared to some of our other worthy competitors and peers. Last 10, 11 years have been really fantastic. Uh, and in no small measure, also, while we've done stuff on the product side, but people like you who supported us and taken our products out, recommended it to your customers themselves, investors themselves, for showing faith and, in some sense, understanding what we are doing. And as you said, markets will not always be favorable to a kind of an investment strategy. So, but to understand and take that effort to understand what we are doing and have that confidence to be able to really benefit from the long term from our investment style. So I think those are two or three important ingredients in some sense for where we have been really able to reach. So it's not just us, but also the communication, the fact that you've understood what we are doing and had confidently pushed it and talked about it to your customers. So I think you have an equal role to play in our success. Interesting question about my childhood. I'm a Delhi boy. I still at heart, while I've spent last 30 years in Bombay, but was I didn't. I grew up in Delhi, and my father was a bureaucrat, civil service. He had just one job. It was largely in Ministry of Finance, central government. So I was put right in there. So first 20 years in Delhi, six schooling, and then 4 years I went to IIT Delhi and did mechanical engineering. Uh, Great times to grow up in a government colony in Delhi. Wonderful relationship, lots of kids, lots of friends. And as they say, people learn while you go to a school, you pay the principal or let's say the school a fee, but actually you learn more from your classmates, etc. I think the same thing. We had two schools in that sense. One is the actual formal school, and the other the environment in the around the house, about 120 families and all people with similar backgrounds and what have you. The
Which
learning
area
at
were
that
you
stage.
in?
Sorry.
Sorry, which area were you in?
So this was the Lutyens Delhi area, very close to where the Hotel Meridian stays. Unfortunately, that society is no longer there, but yeah, fondly remember those times. Learning in those times with the kind of background we had and the ethic was that you have to work hard. I mean, life is it's tough, it's competitive, and you have to be. There are no shortcuts, and you have to work hard to get into. And education was seen to be the route for success anyway. So it worked well for me. Went to IIT and then I went to IIM in Calcutta, and that is where I first came across stocks and markets, equity markets, and I just fell in love with it. It's my second year. That's when I did a lot of research. Data was hard to come by, especially sitting in a campus far away from the city. But whatever it was, to try and build models on what works, what is it which drives stock prices, and all that, and some bit of technical analysis as well. So those, and it was very clear that's what I wanted to do. So lo and behold, I came 91. I came bang in the Arshad Mehta boom time into the markets, SBI mutual fund. That's where I started, and then it's been a series of number of maybe just two jobs in between, but a lot of learning in the markets. And I must say, I think uh, one of the things which you really realize is that long term, if you really have to do achieve anything, I think you have to be at it, not get sidetracked by the short term at sometimes irrational things which are going on in the market, which is essentially to say, don't fall sway to sentiment. Now, I can say today, after 30 years, it didn't sound like that at that point in time. You lost a lot of money, your personal investments as well as client money, unfortunately, but that's the kind of tuition fees you have to pay to be in this market. But I think that today there is a lot more information, material, knowledge available digitally as well as people talking about it. But yes, I think you talked about a wonderful thing about behavior, and I equate behavior with responsible behavior, and and I think in this whole chain of financial freedom, wealth building, optimizing portfolios, etc., there are three parts to that entire chain. One, we as asset managers have to act responsibly, which is the same thing. I mean, invest in things which have value and have while we know markets are volatile and returns are indeterminate, absolutely, but we can certainly decide where in the markets we want to operate, and that provides some kind of assurance. I won't say guarantee, but some kind of assurance to investors, and that's responsible investing. The other people in the chain, obviously, is you, Sanjeev. You are the ones handholding investors, so you have to, be responsible to them, which I'm sure you always already. I mean, I know for sure that you always are, and your investors find the same. So basically, advise them on the right things, like advising them to invest with Axis in one sense. And third, I think the most important one which you mentioned, we need investors also to be responsible. While we will do all the hand holding and the knowledge sharing, etc., I think investors have to commit to a disciplined journey and not get swayed. We all get swayed by short term trends and sentiment in the market. And the wonderful thing you talked about is overthinking on risk. You overthink on risk and really underthink when sometimes markets are just going somewhere and you just want to, because you missed out, you just want to jump in. So both things have to be managed, and that management can come only by one understanding that individuals behave in a manner which is not conducive to their long-term wealth building program. So there are pitfalls in this journey, and that's, I think, our job and Sanjiv and Bajaj Capital's job to make you aware of that, and then for investors to internalize and then say that yes, we will not make those kinds of mistakes. And then I think all of us, if all of us behave responsibly, I think we are all on our journey to really lots of riches and prosperity, which these markets really. And I think I can come to it and talk about it later. But I think in India we are really blessed to be at a time as the economy is developing, that there are a number of wealth creation, wealth preservation opportunities, which if you look around in the world, they're probably just not there. So I'll stop there. I think it's a long initial comment, Sanjeev. Over to you.
No, no, but I agree. I think one point you made very well is that it's all about discipline and it's all about persistence. I discovered a concept called design thinking, which was premiered at Stanford and then really used by Apple. And I personally did, this program from Stanford in at the start of the pandemic. I said, we are here at home. Let me do something different. And me and along with my team, we got into it. And what we realized from that program is that we interviewed so many people about people who had done well in the market and people who had done badly in the market or who didn't have a great experience. And what I realized, Chandresh, was that it was just a difference of understanding a little bit of basics. That if those people who understood those 4 5 basics, which are very simple, jo aapke aur mere liye these are back of our hand, but for the investor, if he understood the basics, कि look, market will go up, will go down, I have to remain invested, I shouldn't invest when everybody is investing, I shouldn't sell when everybody is selling, and there are these 7 8 10 concepts, and if you know those concepts and you know of them and then you start your journey, because otherwise you don't even trust your wealth manager. And there that's also right, sometimes you do come across wrong people, because at the end of the day we are a people based industry. If a person doesn't want to do the right thing, you may have the best ethics in the world, but you can't make him do the right thing. But at the end of the day, it's just a basic fundamental. So I think as an industry, our responsibility of educating the investors and educating the people, and especially so many people have started trading, but they don't understand the fundamentals. And you and I know it. Right now, we are on a top of a cycle. This will go down. And there is a saying, whatever goes up has to go down, and whatever goes down has to go up. So point is that there are so many people who are not going to be making money in the long run unless they don't understand the fundamentals. So Chandresh, my next point is that you're a firm believer of financial planning. And I know that you have been supporting it, pushing it, and your own planning in life. So one personal question I'll ask is that today, when people all the youngsters all think about the job is only for 2 years and you have to keep moving to get growth. You have only worked in three organizations, your whole for the last 3 decades. So what do you say about being persistent with an organization? And a lot of people feel that I will not get a growth if I'm too loyal to an organization. Is that correct or wrong? And second thing I want to ask you is that you like to talk about financial planning and financial freedom. And I know I've heard you talk about having enough money for today and tomorrow. Just if you can explain that, how does a
Right.
person, what is enough for today and tomorrow?
Great questions, and it's so. Let me tell you my view on this. I think let me take the second one first. Financial freedom is basically a situation where you can face your financial future with confidence. Now, it obviously means the first step has to happen, and that is planning. As they say, success has to be planned. It just doesn't come to you on your own. And I'm going to use this to answer the first part of your question as well. I think when we say we want So it's obviously for people who are looking at their future. So that's a first, it's a good place to begin with. At least people are thinking about their future. When they start to think about their future, then obviously they want to think about and say, okay, I want to ensure that my future is well taken care of. And you've talked about retirement earlier. It could be any other thing, and I think retirement is one big part anyway. And in future, I have to have whatever X amount of money to maintain my lifestyle, meet other needs, specific financial obligations, whatever it may be. Now, automatically, as you start to think of this, this has the first seed of planning. What is it that you want to achieve through your financial planning? What are the goals, etc.? And these may not be specific in terms of I need X crores or X lakhs, etc., but it forces you to think that how much is enough. I think that itself is a one question. People don't know that, no, I'm okay, I'm ready to plan for the future, but how should I do it? How much is enough? How much do I need? So I think that's the seed for getting into actually a planning exercise. And as I said, once you get in, once you plan, then I think success will come somewhere down the line. So it is planning and execution. These are the two parts to it. If you don't plan, whatever you execute probably doesn't make any sense. And so get onto the planning side. And I think you're 60% through if you are able to plan and see what probably needs to be done. And then it's about execution, how to go about doing it. So when I say that we as an organization and AMC mutual fund as an industry, and I'm including not just the manufacturers like mutual funds, but also advisors, MFDs, all the intermediaries who interact with customers. I think our job, first and foremost, is to get that message across that we are all there trying to deliver financial freedom to our investors. Yeah, I think that's the big goal, the big purpose of the industry as such. And we need your help for that. And be open to, there are times when, as Sanjeev mentioned, that you just run away from it because the sentiment is very poor. There are times when we are blindly just getting and following in somebody because he's made a lot of return. I think we have to individually chart our own path, just to have our own plan. And that's the first step for financial freedom. The second question, or rather the first question, as you asked, was what is a better strategy? Whether people should stick around in companies or whether they should move companies, etc. I think there is no specific answer, but you have to go back and ask that same question. I want, so if financial planning is about the financial future, then career planning is about your future in your career. And how do you get to where you want to get to? Does it mean you should stay in one place and that allows you to grow? Or you want in between to have a different experience and which will help you to achieve those goals? And I can give you a specific example of mine. Um, I started in 91 with my career in mutual funds, and I virtually two organizations till 2004 in the mutual fund side. And I had the benefit now in hindsight. I moved out of the industry and got into international funds, investing in India, but with a different lens, which was long short investing, typically called hedge funds. And that gave me such an exposure, not just to the approach of investing, but you met so many different people. Hitherto, you were talking about with two Indian companies, Indian advisors, Indian people. 2005 to 2009, I was really blessed to talk to various fund managers globally, investors. I mean, I've learned. I mean, you see, sometimes feel that if we are fund managers and we are going to talk to investors and give them gyan and tell them what to do, I think they are such fantastic investors from whom you can learn. I had been in business at that time for 15, 16 years, and some of these had been investors for 40, 50 years. So coming back to it, I think it's the wealth and the breadth of experience. One, you have the vertical, you have to be really good at something which you do, and the organization should allow you to do that. At the same time, you need some breadth. And if breadth requires you to probably move around, and I hear a lot from the young tech guys today that they want to work on different technologies, etc. And there is obviously a lot more, what I should say, people want to feel a little bit constrained if they are not getting newer experience. So I would not completely denounce job hopping, etc. But then do it for the right reason. I think it should all be part of a plan to get the relevant experience for you to move ahead. Having said that, I must say that there has been enough rewards for people who have stuck around in organizations. I being one of them, I can say that. So I think there's no uh, nothing to say that staying or shifting, which one is better. But too much shifting, I think, can be harmful.
Yeah, in fact, very well answered. All the questions, Chandresh. I think they were, you gave a very comprehensive answers, and also in my mind, I have a lot of other additional questions that come out of your answer. But I wanted to quote my father. He says that look, that success is 99% hard work and 1% luck, and most of us think that luck we can't see, but he takes this example of Mahabharata. He says, look, who was the most ethical person in Mahabharata? And if somebody will say Yudhishthir, Arjun, but at the end of the day, the right answer is Bhisham Pitama. But he is not considered as a hero because he was on the wrong side.
Losing
So as
side, yeah.
per him, luck is being in the right organization, which will allow you to do the right things and grow. And if you have that 1% luck, then the rest is all 99%. So I agree with your story that change should be for only the reason that you're not in the right organization. Once you are in
All
the
right,
right organization, if you stick, then there is nothing or no one who can hold you back.
got you back. Sure.
Yeah. Yeah. So, Chandresh, now coming to the markets, there's a gentleman called Ayyar Ganpati. He's asking a very relevant question, and I thought we must answer it. He's saying, with the Sensex and Nifty peaking again, is it the right time to invest, especially looking at the forthcoming budget, inflation, COVID conditions? And what is your thoughts on this, and what are the sectors for investments that you feel would be good given this situation?
So I think now these are the questions which I'm always very afraid of. Now I can go into it and give a big, long answer on that, but if I can be a little upfront on that and to the point of not sounding rude, it's irrelevant. I think from a long term perspective, and you can choose to look at your portfolio from two or three different lenses. One is your long term portfolio, which I think this particular question is not going to help. Whatever I say is not going to help you make a call on. But yes, if you have a shorter term point or you have a asset reallocation question which is in your mind right now, yes, maybe this will be of some relevance. I think enough money has been lost or opportunities have been lost trying to predict what the market is going to do tomorrow or next week or next month or let's say the next 3 months or even the next year. I have known people who in 2008 9, after the fall when the market came up, they said this is not sustainable. And 10 years till now, they haven't been able to get back into the market because they thought, Arey, ye market to abhi gir jayega, it may fall someday. So I think while your point is right, the market is making a new high, but that's the job of the market. If you look at the Sensex 1978, 79, when we got the index, they have consistently made new highs, and from 100 now we are at 60,000. So highs are meant to be broken. Can I, with any degree of confidence, say that from here on for the next 2 years the high won't be broken and things will be down? I mean, look at just the COVID situation. I think June, July of 2020. Forget March. March anyway, you could have made out a call that hey, the market has really, really gone down to 7,500 and there should be some bounce. But after that bounce had come in July onwards, could anybody have said that we will actually be another 100% above those kinds of levels? Nobody. So I think trying to, while it's great, it feels very great. Sometimes you do take a call and you are right and you feel that, yeah, I've got some super skill. But I don't think you should kind of look at that because I have known zero people who can really predict the market. What people are good at predicting is direction of how individual businesses and, to some extent, segments of the economy can really look at. So I think one should focus on that. Budgets have always been, I mean, if I were to look at just the past data, the markets have always peaked around the budgets. You have a pre-budget rally, Santa Claus in December, and pre-budget, earlier budget used to come in February, and there have some big falls have been seen. Can I take a call that we should just sell out because there's going to be a big fall, or there's going to be a rise at least to the budget? I think it is all irrelevant to my point of view. Having said that, I think I am reasonably positive about the corporate sector. That is the real reason to be in markets. The real reason to be in market is not because India is a growing economy and all that. That is always fine. China has been a growing economy for 30 years, and their stock market has returned 4% in nominal terms. So the wealth building happens at individual company level, and ultimately, and that is what gets reflected in the indices over a period of time. And whether one budget can change a company's wealth building trajectory, etc., as I have not come across that, and that is all very too intrinsic to companies. We are seeing an evolution of new kinds of companies, which are really very, very, what I should say, agile, and have demonstrated a lot of speed. They're really teaching existing old companies also new ways of managing businesses, etc. And that kind of makes me feel that wealth creation will probably be faster going forward because of management practices, because of disruption, because of technology. So don't worry about the budget. Buy before the budget, buy after the budget, irrespective of what happens to the market.
I think very well answered. And this is something we must clarify to our investors. Okay, guys, trading is not investing. Okay, so a lot of people mistake trading, buying and selling. That's a business. That's a job you're doing. But I don't think anybody has made long-term wealth without investing. So investing is that part of your money which you don't have to work on it actively, which is growing on its own. It's like, again, I will take a quote from my father. He says, investing is like a rental income where you have to put in that effort of choosing the right tenant. That's it. And after that, your income is coming and you're just maintaining your investment. And your so point is, okay, look, so when you think about investing, don't think of this trading that you do, buying, selling as investing. Investing is that part of your corpus that you will choose the right fund manager, let it sit, you spend a little bit time on maintenance, and then that's it. So I hope we have been able to.
Interesting. Yeah, yeah, very well said, Sanjeev.
Yeah, yeah. So Chandresh, you know him. He's great at his quotes and his research.
Yes, I have had some opportunity to interact with him.
Yeah. So again, lot of questions about market behavior before the market and before the budget and after the budget. And I think Chandresh has already answered that. Umesh, he's watching our talk. He's asking this question. That don't bother about it. At the end of the day, in the long run, whether you came in before the market or after the budget, it's not going to matter. What matters is the companies. That does India have good companies which can win? Is that Indian economy going to remain stable? Is India going to overall is it going to win? So if India is a good place to invest in, India has good companies and which are going to thrive and grow, then you should be a part of that market. As they grow, your money will grow along with that. There'll be times when they'll be overpriced, they'll be underpriced, but eventually they, whatever is underpriced today will get overpriced in the future. Whatever is overpriced will get underpriced, but eventually will become overpriced again. So I think this cycle will keep going on and on. So
Just
Chandresh,
one point there. The countries must survive these cycles, and do well, and that's what we talk about. Forget about the stock market, the price being overvalued, undervalued. From a business perspective, they must keep investing and becoming more competitive and all that. If that is there, the longevity is there, and they continue to on their P&L generate reasonable ROEs and continue to develop strengths. I think, as I said, I think we are really lucky in India that we have at least 300 of such companies. I mean, the market is a lot, and that's enough for us to really build with. That's something which you don't have in China, by the way. 10% real GDP growth for 25 years, but still markets giving you only 4% return. And we are the other way. And so the companies are already doing their work. We just have to do our work. Just be with them.
Yeah, that's again very well answered, Chandresh. So again, there's a interesting question, quite open ended. That Chandresh, what would be, this is Mr. Murari KS? He's asking us, what would be your investment strategy for 2022?
It's a similar one. I think I've answered that. But if you were to kind of, there is somebody who's saying, I want to start investing, let us say. Uh, I think when we say start investing, which means probably is already in fixed income, has some money, and then asking about what to do from what both fixed income as well as an equity perspective. I think one of the things which Bajaj obviously does is to have some kind of a target asset allocation. I think that's a good place to start with. Whether it is 2022 or 25 or 21 doesn't matter. The second question comes is, let's say hypothetically, I think 50-50 works for most people, but it could be different for different people. Once you've got that target, do you get in on day one? Uh, on the fixed income side, where volatility is relatively low, maybe you go in quite in a very short term period, maybe a month or two you can take to kind of build that out. Equity being a volatile asset class, it's always, and we all know how SIPs help and regular investing helps. Maybe take a 6, 9, 12 month, whatever you are comfortable with, build out and reach, let's say, a target asset allocation, maybe 12 months or 6 months or 9 months from now. I think that's what one would do. Now, we can get into more detail about that, what kind of products, what kind of large cap, mid cap, small cap sector, and all that. But as a first step, solve for the core, the long term, large cap diversified or a multi cap diversified kind of makes the first part of that core, and then you can probably add a few new themes. And this is something which we are now also propagating, because new themes, in the sense you could go international. I think last 3 years we've saying that people must have some part in international portfolios, just because opportunities are large. So what we are seeing, technology, etc., making a difference to Indian companies' wealth creating ability. It's happening world over. So why stay away if those opportunities are there? And number two, in India, also look a little bit at some of what we call the thematic stuff around disruption, around technology, around disruption enablers, etc., etc. So I think have a large 70-75% core and 20-25% in international plus some thematic. We are not in favor of sector funds, because that really limits your ability to move around, because nobody is going to come and tell you that, hey, अरे ये sector का काम हो गया, अभी कोई दूसरा sector ढूंढते हैं. I think that, to my mind, long term has not worked. Short run it looks great, but would probably advise people to stay away, unless there are some really sophisticated investors who think they can time their way out of it. I think, and if you do this, I think, and you stick to this and stay with it, I think you'll do better than 95% of investors. There's one more thing I want to talk about is, so once you've reached your target asset allocation, I think it's important to, on a periodic basis, revisit that. That period could be 1 year, it could be even 2 years. Uh, what that allows you is to sell the asset class which has done really well and buy the asset class which hasn't done well. So let's say you started with 50-50, and let's say equity now has become 60% of your portfolio, debt is 40%, which means actually equity would have done much, much better, which means might have given you 30-40% return, because debt on its own would have given you something. So that 50 may have become 55. For it to become 40% means your overall portfolio would have been 140 or something, which means your 50 in equity would have to become something like 80 or something. If that has happened, then please rebalance. And I'm sure all of you have heard about Einstein talking about the eighth wonder of the world, which is compounding. And me in Axis, I was saying the ninth wonder of the world is rebalancing. It allows you to maintain a reasonably low risk in the portfolio, but in the end, actually come out ahead as compared to even 100% equity portfolios. It's a great tool if you can do that. Even if you can't do that, doesn't really matter. But if you can do that, that can really add wonders to your portfolio.
Yeah. So I think Chandresh, amazing answer. That guys, one is that please make sure you do your asset allocation. So asset allocation is deciding between how much money is going to be in equity, debt, what is going to be the format for your basic foundation portfolio. Then second is that when the markets are doing well, it's always good that you must, even good time, bad times, keep doing asset reallocation. That means when the market is doing well, your equity allocation, suppose is supposed to be 60%, comes to 70%, then move that 10% into debt, because that's the profit booking you're doing. And when the markets are bad, your equity has come down from 60 to 52. It's time to move money from your debt into equity, because that's probably the best time to buy. So it is very, very important for us to do our allocation, and that's what Chandresh has just told us, and that's what is going to get you a good return. So here there's a question by Mr. Mathur. He's asking that when will the Sensex come down, which is bound to be. But I know it's a very difficult question for us to answer, and I think Mr. Mathur, nobody can answer that. But there is a product class that Chandresh, that is there in the industry, and it's being marketed aggressively by all mutual funds, which is hybrid funds or the balance advantage. And as your ex peer, I like Nimesh's quote that he keeps saying that whenever you are confused, invest in balance advantage. so and I know balance advantage. So why don't you tell the our audience a little bit about balance advantage funds and how they actually automatically do your asset rebalancing and do that. So they are a great investing class, and especially in a time when you believe the market will come down. So
Yeah,
Chandresh, I'll let you talk about it.
yeah. So I'm sure many of us and many of you would have heard about some kind of solution-oriented product. So when we talk about solution, we normally talk about goal-oriented products, retirement and child planning and all that. But I think balanced advantage is, I would say, providing solution to one of the biggest problems which investors say they face. I think part of it is perceived, but part reality as well. And we must understand if investors perceive or feel about something, then we have to take care of it, rightly or wrongly. I'm not getting into the ethics of that. So if there is an expectation that investors have that, hey, help me navigate the volatility in the market. No, I am not able to live with such extreme volatility in my portfolio. I know volatility is a friend, and we have given you all kinds of data over the last 30 years, studies, etc., and told you that volatility is your friend and don't be worried about it, continue your sips and all that. But unfortunately, I, as an individual, I am human. I am affected by psychology, by prevailing sentiment. I am not able to manage large drawdowns, etc., etc. Then you need a solution. And if you can't do it, I think one of the easiest ways to do it is to get into a balanced advantage kind of product, which will take that reallocation decision and help to control the drawdowns. In some cases, if it really is able to do very well, then obviously it depends on the skill of the manager. Over a period of time, some of these funds can end up doing even better than equities. And it's part of the same rebalancing story, which I talked about earlier. It happens rather than happening on a 1 year or a 2 year basis. In these funds, it happens on a more continuous basis. So that's in some sense an advantage, in some sense a little bit of a disadvantage. I don't want to get into the mechanics when it is, but I think as an asset class, it answers that basic question: that what if the markets are going to fall, or what if the current sentiment is so weak and I on my own cannot bring myself to invest in the market. I think give that decision away to the fund manager. I think most of these funds have had a fantastic track record. They may sometimes miss out on some opportunity, but I think looking at it 5 year, 10 year perspective, these are great stories. Some of these products have had very, very long-term track records. Some are fairly new, but new in the sense they are around for 3, 4 years, etc. You have to go into it and see which ones have been able to get it right more number of times, etc., etc. You can do that. I'm sure Bajaj can help us do that. But these are a great asset class. If you are worried that you will not be able to maintain uh, the asset allocation and be on the disciplined path yourself.
Yeah, so I think Chandresh well, guys, whenever you're confused about the market, about so simple balance advantage becomes the sort of the bread and butter funds for you. Just put your money into the balance advantage. Don't be on outside. Be inside the market and let the fund manager choose that how much money is going to be equity, how much money is going to be in debt, and let him keep moving about as per the market cycle. So, Chandresh, next is a very interesting question by this gentleman called Mr. Madhusudan, who's a regular this thing, and he always asks very technical questions. So, he's asked a question which is about the way markets, we have what has been happening. He's saying the cycle of any AMC performance is like a seesaw, as sometimes it's bottom poor yield, then it turns around to be top. How can the we investors decide which ones are consistent? So, this is something which never used to happen. Earlier, it was a fund class which used to, but right now, last couple of years, because the markets have been behaving in a very different manner, we see that sometimes some AMCs are performing really good, then they really come down the quartile. Again, this is, paradox of the industry. How would you like to answer that?
It's a great question, and I must upfront admit that we as asset management companies do not give, or even if we give, sometimes for people to understand that it is just takes too much effort. So we don't kind of spend that much time. But I am going to take this opportunity to basically say what I we feel about this. See, I think at a, since you said that he's asked technical questions, I'm going to become a little technical. And you like just take two assets, or you have a choice to build your portfolio with two assets, and uh, there will be sometime one will do well, and sometimes the other will do well. But what do you want to see in these assets? You don't want to basically say that hey, one time, because I will not know at one point should I buy only A or should I buy only B. What I want to have is those two assets which, on an average, let's say over a 5 year, 10 year period, give me the highest, in probability it's called expected return. So on its own 10-year period, this strategy is likely to give me say 18% return. And then say let's say there's another strategy which, while it's uncorrelated, it may do well in different times, but say it's also going to give me 17, 18% return. So I would like to build my portfolio with these two kinds of assets, knowing fully well that at one point in time A might be doing really well, at another point in time B may be doing well, but overall I will get a good performance. The problem comes when we suddenly see a C asset which short term has looked to give fantastic returns, maybe let's say 30%. And I can see that and I can relate it to what we are seeing in the markets. Maybe a sector fund, maybe some people, we have not talked of cryptos here, but let's say something like that. Now, long term, what is the average return? We don't know. If we have no predictability, we should not suddenly introduce a C into the portfolio and then say my high performing A and Bs are poor performing portfolio. I think that's the big mistake. So, idea is understand the strategy, why that strategy will work, and what it is likely to deliver. For example, a high quality growth strategy should, over a 5, 10 year period, do 3, 4, 5, 6% better than the index. And it becomes a core portfolio. Then you can look at some of the other strategies similar to that. Somebody has taught a momentum strategy, very difficult to say what returns it will give. We've got value, and I will not get into value because it's a very, very debatable topic what comprises value or what comprises value traps. But a value strategy done very well may do reasonably well. So, idea should not be to look at AMC's, idea should look at style of the fund manager in that particular fund. You may be able to actually find two uncorrelated investments in the same AMC. and different times, different strategies will perform. So we need to have, I mean, normally we will have more than two funds, so maybe five, seven, eight funds who have high expected return from a long term perspective. And if we can find them uncorrelated, that is great because my risk kind of comes down. They will not all go up at the same time and all go down at the same time. I think that's the way to really build a portfolio. But do not compromise or kick out a long term good performing fund because it's underperformed in the short run and it looks very tempting to put in something which has done very well in the short run unless you have reason to believe that asset C or fund C can have equally good long term returns from here on. I know it is difficult to do because past returns are what drives our perception of future returns, but that's an exercise we have to
Yeah. So I think Chandresh very well answered. So, guys, yeah, just to summarize what Chandresh has said, okay, look, I will add a little bit from my side also. Earlier, what was happening was that when the blue chip funds were doing well or the top 50 funds, then most of the blue chip stocks would do well, or same for mid cap or small cap. But what is happening in the last 4 5 years, and it's this started in US about 10 years back, that out of the whole sector doesn't do well, but some stocks do well in that sector. So earlier, like if there are 50 stocks in the index, all of them would do well together, all of them would do badly together. Whereas now, what is happening, out of those 50, maybe 15 are doing much better than the others. And this is something how the global markets have changed. And that's why, performance of some of the asset management companies who have taken those right call becomes exceptionally good. And then eventually, when the market starts doing something different, then the performance comes down because it's the thematic or it's the call. And that's where, today I think actively managed funds have become much more important, and they have become much more like people are preferring them more than the just the markets or the indexes where the performance has been quite average. So it's a matter of that, but don't take a decision on a short term basis. Decision needs to be taken on the basis of research, the future, what is going to be there. Like we at Bajaj Capital come up with a mutual fund select list where we are recommending funds, that these are the funds that you should be invested in the next 1 year, 3 year, 5 year, with our own logic. See, that logic can be right or wrong. There is no soothsayer in the industry, but it's an opinion, it's a research, it's a view basis on some fundamentals and economics. So please do follow that. And every AMC has good funds. Every AMC has sectors which may not do that well, and you have to just make sure that your fund manager is able to give you good picks, and there is consistency in the AMC, and if that is there, you will get it in the long run. But it is also very important for you to keep reviewing your portfolio, not on a daily basis or a monthly basis, but at least once a year, to make sure you're invested in the right side. So I hope you agree with that, Chandresh.
No, absolutely. I think completely agree with you. I think just stay in. I think in good funds, nobody can say which fund will do specifically better. It's very difficult to say. You must have reason to believe that this will do reasonably well. I don't think anybody can tell you that this is going to be the best performing fund over the next 3 5 years.
And another question is again a very interesting question from Murali KS. He's asking, okay, like, I know you would love all your children, all your schemes are your children. So he's asking you to recommend
Sorry.
some good large cap, mid cap, and flexi cap schemes from Axis, or which is the Axis schemes which you would like to recommend to our audience today.
So I really, when you say audience, I think I know there are different kinds of people. People with low risk. I think the blue chip is all-time favorite. I think you can't go wrong with it. We don't know what the markets will do. Lowest risk product, first entry product, apart from hybrids, where anyway you have maybe 40, 50, 60% in equity. A pure equity product, the first product which we would always recommend, irrespective of times, is the blue chip fund, the large cap. Has to have a reasonably large allocation in the core portfolio. Then we come to, if anyway you have decided that you want to do more and not just your risk profile is better, either you can add on a mid cap or you can do it through what I would call as the multi cap or the flexi cap. And these categories have become very, very popular right now. In a sense, these becomes fill it, shut it, forget it funds. Because you don't have to then take a call कि भाई कितना कब mid cap में जाना है, कब large cap में जाना है, etc. and all that. I think these are so. If the risk appetite is very low, blue chip. If you have slightly more, then it's either the flexi cap or the multi cap. And then buttress it with two other kinds of products. One is the international. So we have a global alpha product, which allows you to invest globally, take exposure. And then there is a special situations fund, which we have locally, which invests in disruptive themes. And I think that is important. And I don't know whether we have time to talk about it, but I think most investors are, and we as investors are looking at these new opportunities, new areas, how disruption as a theme is going around. I think many of our large cap companies themselves are turning disruptors to their own business models. Yeah, but and changing the way business is done. So I think you get these three or four or three products or four products. I think you get exposure to the entire range of opportunities which are there globally.
Yeah. So I think it's a very interesting aspect. I think we must take up this global disruption fund because Chandresh, you have also recommended that 20-25% of your portfolio now needs to be in global stocks. And this is something I have been talking about to my team and to our clients that this is a time where we are living in a global economy. Early, Indian companies were operating in India and it was fine if we only invested in them. But today, even an Apple is coming and doing humongous business in India. Google is doing humongous business in India, and so many others. So when we look at building up a portfolio, it needs to be a global portfolio. So just tell us a little bit more about this global disruptive technologies fund that you have created. So what is it about? What kind of companies will it be investing in? What is the kind of stocks? Is it going to be all international or some Indian companies also? So we would, and it's a very interesting fund, guys. Typically we don't cover funds in this talk, but this is a very interesting, very innovative fund. So I thought we won't do justice to the talk if we don't cover this.
Yeah, so very interesting area. So we look at disruption as a, a tool, or I should say, route for rapid wealth creation. Now, we all know things are changing, and COVID has shown how online is disrupting. But online and e-commerce and all this is one part of it. There is disruption happening many, many areas in manufacturing, robotics, automation, artificial intelligence stuff, in genetics, pharmacology, biotechnology, many, many areas, and things like urban renewal and all that globally, where we may not have cases to invest in India, but these are things which are really companies which are really changing the way business is being done. So you classify them into three buckets. One is an enabler. Why is it people like Infosys, TCS, etc. have done so well? People have realized that they are the ones who are going to enable change in technology, cloud, etc., etc. People are taking Fortune 500 to Fortune 50 companies online. So they are enablers of the technology, yeah, or enablers of the disruption. Second are people who are actually doing the disruption. And many of the Indian, we can call them startups or late stage unlisted companies. So many of them are there. I think I don't want to take out specific names, but I think all of us are doing and started off with Flipkarts of the world, and now there are just so many of them, and they have become part of our daily lives. Third, others are people who are benefiting. There are downstream benefits, etc., which this disruption, and there are many other people in the ecosystem who are helping us do that. And we're doing it at two levels. One is at India level, that's where 70% of the portfolio is, and 30% is to have these disruptors, enablers, etc., on a global level. So other details I think we can discuss and think about. It's a recently launched fund because the theme itself is fairly new. Products done fairly well, and happy to talk more about it. But The idea is today we hear a lot about people saying that, hey, this kind such and such company has kind of generated multiple times the wealth the good quality companies in the market have done as a group. The only problem is that some of these are, when they start off, the stage at which people would like to invest and then to see those multifold returns, there is a little bit of risk in these businesses. So while the asset class on its own has delivered very good returns, individual companies may actually do poorly, depending on how. And we've seen it in the Indian startup and private equity space. You get sold out, or you have to shut the business and all that. And that sometimes makes people worry that whether they will be able to really participate in these kinds of stories. As individual company associated risk is fairly large, and hence we always recommend that this has to be. So as investors, can we say individual company risk is large, so we will stay away? I don't think we can say that, because this is where phenomenal amount of wealth is going to be created. The only thing is, it's not, as you said, all 50 stocks in an index or in a portfolio doing well. Maybe it is 10 or 15, but then these 10 or 15 will more than compensate for some of the losses you will have in the portfolio, so much so that the returns will actually be a lot higher from the more perceived to be safe portfolio. So I think this is an idea whose time has come. Technology, I don't think there's any looking back. Disruption is going to run for the next 15, 20 years. If it was a 3 year, 5 year story, we would not have gone it and said just stay out and just no 3 years, 5 years nikal jayega, koi farak nahi padta. But I think what we are seeing actually is a further acceleration. Um, we've been in a number of webinars, tutorials, what have you, workshops. This is here to stay, and it is. We have to change. We have to learn to change ourselves. Having said so, if that is the case, then and knowing fully well that individual companies might be risky, the only way to play it is high quality portfolios, maybe 30, 40 names across these three. So across the three buckets also, there is the enablers, there are the disruptors themselves and the beneficiaries, the downstream beneficiaries of these disruption. I think the risk in each of these three buckets is different. So build a portfolio, which is what we have done in our special situations fund, essentially a disruptions oriented fund. One third of the Indian allocation is in enablers, one third in companies which are actually doing the disruption, and one third who are the beneficiaries of the disruption. So uh, I hope that answers, Sanjeev.
No, I think
And then the
that's
same thing is
very good.
replicated on the 30% international portfolio, which we invest on advice of our partners, shoulders, who are a joint venture partner in the mutual fund.
Yeah. So I think that's very good, guys. This is a slightly more higher risk one, but it can give you that additional amount of return that some people who are looking to for a kicker to their portfolio. So this is a product that you must look at. A lot of people have asked questions about other products like Parik, Flexi Cap. Are they good? Yes. I'll answer it. Yes, they are good funds. They've done well. They started this concept of having an international portfolio. So point is that as an industry, we have to respect all those who have done well. And there are some very nice innovative funds coming in who are looking at a bigger portfolio. So obviously, yes, and that's where Bajaj Capital comes in helping you select the right portfolio. Mr. Sandeep Kandhari has asked the question regarding retiree, which fund would you recommend? So here, Mr. Kandhari, I like to say for all the retirees, please get a retirement plan made. It is very, very important because your money, what you are going to earn, is not going to be earned again. If you lose it, then there's a problem, and you need to know how to spend it, how to make it last. So point is that we would not like to give a very generic advice. That retirees do this or do that. It is every retiree is different. There are some retirees who have enough fresh income coming in. There's one of my own teachers who had retired, but she had enough money coming in from tuitions, and I told her to make 100% equity portfolio. And today her portfolio value is above 5 crores, and she's been retired for 15 years, and she's seen the best of the market. So it's not the same answer is not right for everyone. So please get your retirement plan done, and it's important, especially for retirees, to get it done. It's a free service by Bajaj Capital. get it done. Go, if you want to use Bajaj Capital, use Bajaj Capital. Go anywhere in the market. This thing.
But do
So
plan.
with your plan. So I think thank you for taking out time, Chandresh. One last question that we'll take. There's a gentleman, Ankur, who's asking, okay, look, I have a 10-year horizon. I want to choose an Axis portfolio. What would you recommend? So I think this is one last question we take, and then we are over time. Guys, please write your questions, and we will answer. Make sure each and every question gets answered. If even if we are not able to do it online right now, we'll do it offline. Every question will get answered. So please write away with your questions. And this is the last question we'll take. There is a QR code. You can scan that on your mobile phone, and you can write your question, and you'll get an answer to it. So, Chandresh, finally with this, that 10-year horizon, which Axis fund should he select?
So, great question. I think as we would understand that if you take the right amount of risk, you should get a return associated with that kind of risk. And that's the whole thing about optimization. It's not about maximization, optimization. So if I were to say you invest in a, let's say, mid cap fund versus a large cap fund, and mid cap has higher risk, then over a 10-year period, the rational expectation would be that you should get higher return in a mid cap fund as compared to a large cap fund. And it's a fair thing because beta of a mid cap of a blue chip fund might be zero point 0.8, and beta of or absolute volatility of a mid cap fund might be 1 or maybe 15-20% higher. I mean, obviously, there is a whole range which can happen. So I just wanted to put that perspective before I answer the question that higher risk you take, the better return you should get. The fact that you have a 10-year horizon, and I'm actually going to quote a study which was done in the US. People said if you want to make a retirement plan, which is like 30 years and 35 years, if you're beginning your career, then go and invest in the small cap index. Yeah, and this is a 75-year study. Now, you may not be able to, if you are in the habit of seeing your portfolio every 6 months, you may not like it. So not very many people do that. But that's the portfolio which have done the best over a 30, 35-year period on a 75-year study. But I would not recommend that. I think understanding that investors would like to see relative stability on a shorter term period, I would say if there is one fund you should buy, I think it has to be the multi-cap fund. You get all the three: stability of large caps, growth of mid caps, and some specific real great opportunities which come in small caps. And then there's an opportunity of the fund manager to move across the cap classes, and you just stick with it. I think if there is just one fund you have to invest in, that's the fund I would recommend. Yeah. So is there another any other question?
Yeah.
Yeah,
So I
I
think,
lost you for a minute.
sorry, there was some internet fluctuation. So
Yeah.
thank you, Chandresh, for an amazing session. I think you were simply awesome, and I like the clarity of thought and the kind of direction you have given to people. I think this talk is going to be highly valuable for anybody who watches it. And thank you for taking out this time. I know you have a very busy schedule, and I think all our viewers today are going to appreciate this talk for a long time. So thank you
No,
for
I
taking.
must.
Yeah.
I no, thank you, Sanjeev, for having me. As you might have realized, this is something I'm really passionate about. I think in this country we have so much going for us. So many of these management teams, promoters, entrepreneurs creating wealth for us. And all it takes for us is to not take out our checkbooks and write out and be in the market, be with them. And if that is such a great opportunity is there, I don't think we should let it go. And that's the important message from my side. I think these guys are anyway doing the major heavy lifting. All we have to do is just stay disciplined, be with them, And I think they will take us to enormous wealth creation. I would just like to close. Sometimes we feel no that there are these great investors, and all of us have heard about Warren Buffett and all. I'm not trying to say that by investing in mutual funds we'll all become Warren Buffetts, but we'll become close. I mean, Warren Buffett's 65-year track record, 55 years, sorry, 56, 57-year track record is about 20% compounded return. I mean, we can do 17, 18% long term, 20, 30 years. I think we don't have, all of us don't need to become Warren Buffett, but I think we will do phenomenally well with our wealth. And we don't really need to then worry about our financial future. And in many cases, I think it can become a phenomenal intergenerational wealth, which I'm sure many of people do think about, especially some of the older people, I'm sure, do that. So I think don't, just because you might be a little worried what's going to happen in the budget, something will happen, markets also move up, is going to move up. Let's not lose or give up or lose the chance of benefiting from what long-term opportunities which exist in the
Yeah.
markets. And thank you very much, Sanjeev, for indulging me and allowing me to talk about my passionate topic.
No, no, I think it was great fun and it was awesome, and we need to do this again soon. So, guys, the important thing, as I said, don't invent risk, don't remain on the side. Till you don't play the game, you will not win or lose. And at the end of the day, and this is a game, if you are patient, you will not lose. So, at the end of the day, so please start investing, stop waiting. As if you are confused, choose a balance advantage, or if you want to go for equity and want to be very conservative, go for a blue chip fund. They are good advisors like Bajaj Capital. I like to say that they are there. And a lot of, I'll give one story which a lot of people don't know, that concept of SIP in India was created by Bajaj Capital. And we used to have this concept of make your children lakpati or make yourself lakpati. And we actually ended up creating, we wanted to create lakpati, but all of them, the markets have performed so well that all of them ended up becoming crorpatis. So
Okay.
yeah. So, guys, and we have a saying that we have helped create maximum investment crorpatis. People who have invested, been investing. So it's just about being in the market, being consistent, and starting. So let's start our journey. And if we hope that if we are able to convince you on that, there's a lot of wealth to be created by you. So thank you all for joining. Keep joining, and I hope we were able to add value. Thank you, everyone. Thanks, everyone.
Thanks. Thanks.